Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results.
Good morning, good afternoon, and welcome to Develop Your Edge with Anthony Crudele. I'll be your co-host, Tom Schneider, CMT with NinjaTrader. And thanks to Jim Cagnina for reading that disclaimer. Sounds the same every time. I want to welcome back to the screen, Anthony Crudele. How are you doing, Anthony?
I'm doing great, Tom. Great to be back. Had a little time off, feeling refreshed and ready to go.
You don't look like you've aged 3 weeks at all, but it's been 3 weeks. You look exactly the same. You look refreshed. That's awesome. I'm excited for today's topic, right? Why are commodity futures so important and different from what we're used to trading? So I can't wait to hear your take on that.
No, first off, it is always my goal to always look the same age. That's always priority. What I like about this show and why I wanted to do this show is we saw some news coming out recently about wheat going limit up. Obviously, you have commodities such as gold and crude oil that pretty much everybody knows about. And I think that, crude oil was the last show that we did, and it's a market that I'm continuing to watch right now. And there's just so many other commodities out there that I think that people need to understand the real difference between trading those commodities, even natural gas, versus trading like the S&P or the 10-year. They're different in a lot of ways. And I know that seems odd that some people may say, well, it's just a chart, right? But what's driving behind the scenes in commodities, it has much more of an impact when it comes to fundamentals. And that's the true driver behind commodities versus S&P. I mean, I know the S&P has got a lot of different things in its web, and you'll have this bull and bear debate about, the economy is not great, or you'll have this, but the S&P will continue to probably go higher over time, pretty much no matter what the circumstance it seems is. So you have to understand that when you get into the commodities, that there are certain drivers. And I also have met a lot of commodities traders over the years, and I'm going to share a little bit about some of the styles and things that they do when they're looking at the market.
Well, and that's fascinating. You're right. There's kind of this intangible and tangible aspects of the market. And I think that that's what you're going to get into, right, is the fact that commodities, there's more tangibility to it, which implies different fundamentals than, let's say, like you said, the interest rate futures or stock index futures, where there is something underneath it and driving that futures contract price, but it's not subject to the same fundamentals as other commodities.
Well, when you look at like the S&P, it's probably more technical than it is fundamental. And I know a lot of people will have issues with that, but that is most likely the case. Not the same necessarily for interest rates, because it's all going to be a lot off of what the Fed is doing, and the bond market's a whole nother animal. And maybe we'll get into that someday. But I think what we'll do is because today we're focused on commodities, let's pull it up. I'm sharing my screen here, and I want to go over, once again, these chart decks I provide every single week when we're on Develop Your Edge. Just go to anthonycrudele.com/chart decks. You can go there. You can download them. They're for free. I believe that every presentation that I do, it's good that you can take those tidbits away. And also, I'm actually going to start uploading some charts and stuff in there that I'm showing on the NinjaTrader platform, so people can go and just download some of those technicals or things that I've been putting up there. And that's all at anthonycrudele.com. So what is commodities trading? And when you think about it, everybody calls CME Group CME, right? But it's the Chicago Mercantile Exchange, right? And so when you think about that, where did it really start? It started with commodities, right? I mean, exchanges came into existence because of raw materials, right? People needed a place to hedge their risk. And when you look at the commodities, specifically the softs, look at the Board of Trade, Chicago Board of Trade, the main room there, although many will say is the bonds, and that was a big product there, and that's the most active traded. When you look at the Chicago Board of Trade, the ag room that's really where it started. I've been in that room. I wasn't on that floor. I was on that floor for a little bit of time, but you go in there and that's really the heart of it. That's the root of it. And so when you look at commodities, you have to really think back to the beginning days, because they're really the markets are created and traded the same way they were back then. And obviously with electronic trading, it is different. But when you look at a commodity, the reason why you have these commodities and the pricing and everything when you go to the store is really based off of, the true supply and demand. And so commodities trading is the buying and selling of these raw materials on the futures markets, because without the futures markets, how would everybody know how to price these things? And I think that's one of the most important things. And so when you think about a market like wheat, I think we'll go to the chart later and we'll look at wheat. And there's a lot of stuff going on with Ukraine. There's going to be these supply and demand issues that really come into play, and that supersedes all your technicals. And when I put in here, it's to ensure that commodities are at a fair price. And one of the things that we're going to talk about today is expirations. Because commodities expire pretty much every month, I think, across the board. Almost every commodity at CME and CBOT has a much more frequent expiration than the indexes or the interest rates. And that's to be able to keep the fair market price up front and center, because people are taking delivery. And it helps these businesses manage risk. And I think everybody can understand the basics of why commodities are, what commodities are, and how they impact, all of us as human beings and when we go to the store. And what makes them unique is there's more physical delivery than I would say, I don't want to say it's not comparable to the S&P, which is financial delivery, but there's more people keeping positions into expiration than there is in these other markets that we trade, right? Because if you buy the S&P and you let it close at expiration, you just get financial money. It's however many contracts you have, it expires, and whatever the value is of the S&P at settlement, you're going to get that back in dollars. And so a lot of people really, that's why rollover, we've talked about this a lot in the show, is so important, because most people aren't keeping the S&P. But when you look at a commodity, a lot of people are keeping these commodities in delivery. You can go back, remember what happened with crude oil, and it went negative during the time of delivery, because at the time people couldn't take delivery. That's a fair market price. So if you could actually take it, nobody wanted to buy crude oil at that time, because if they took it, they had nowhere to store it. And so therefore what was going negative in price, people are actually paying for people to actually go and take it and store it, right? And because there was limited amount of storage. And I know there's probably more to that story than just that, but that's the point of it. When you get to these expirations, you have to be aware, especially as a trader, that somebody's buying this or hedging this at that product and they want to take delivery. And so it has a much different meaning at expiration than, like, say, the S&P. And that's why you have this volatility. And you have, like what we talked about right now with the Ukraine. I've been reading this, and, so wheat was limit up the other day, and it's really because of what's happening there. And so you have to know that these news, weather, political events, much more have an impact on it. And I put in there that they're less liquid, and it's not that they're less liquid on the bid and offer, but for example, like, you could go into a situation where I've seen lumber be limit up or limit down for weeks upon weeks, maybe not quite that long, but you have to realize that you're not trading an S&P that's got a 5% or 7% intraday limit down, where the markets really don't hit them all that often. They hit the limits a lot more frequently in when you get into the ags, is because the CME and the CBOT, they put these circuit breakers in there to obviously protect pricing. And so you could really get caught. I mean, I have a few friends that were caught against limit ups or downs in cattle and all these markets, and it could be days before you get out of them. And so you have to realize that as a trader that this market is you're actually trading that commodity. And I think that so many people go in there and maybe look at it just as a chart, but it's not really the case. What's driving behind that is people that actually need to buy something. And I always think about this when I trade commodities. The person who I'm trading against needs to do something, right? The only people that really need to buy stocks are like these managers, these portfolio guys, and they got to come in and they got to buy and sell stuff, right? That's understandable. A lot of that's beginning of the month, end of the month. But when it comes to commodities, people truly have to hedge. People have to do orders. And when people have to do something, they don't care about price as much or sometimes at all. So you have to think about that's why we go limit up or limit down so easily, because they just go, I got to buy them. I need to lock this in. I need to hedge this, or I need to own it. I need to take delivery. And so therefore you're going to get these moves that are probably very different than you're used to in your typical S&P, Dow, or NASDAQ type market. COT data, and this is where maybe, Tom, I think you and I could talk about this a little bit. COT data is so important when it comes to commodities. And I think it's actually not very important when it comes to S&P. And I know some people, there's always going to be people that disagree with you, but I think that COT data, at least what I've learned in my experience, when I'm looking at commodities, COT data is probably the number one tool that I would want to know. And it's that weekly report that tracks the positions of the large futures traders. And I'm going to talk about all these different things when it comes to COT data. And I'm not a COT data expert, but I really look at it just to see positioning. Like, what are the hedgers doing? What are the large speculators doing? And you want to see that because although when you look at it maybe versus an S&P, where the S&P, you're going to mean it's pretty much all speculators, right? And when you look at it, the S&P doesn't have, I think, that when you look at COT data, that true value behind it of knowing actually what the hedgers and what some of those people are doing. Because once again, what's the major difference? They have to do it. And so their position sizing really matters. And if you see positioning off or too leveraged in one area versus price, that's where you can find some really good opportunities. Tom, as a CMT, I don't know how much of this do you guys talk about COT data when the CMTs are all meeting up?
Well, it doesn't come up that much in the CMT, when I'm talking with my friends and all that, but it is data, right? And so you mentioned positioning. And so just like any other data, it isn't price data. It's actually position data. You're looking for changes. You're not really looking for levels so much, right? You want to know what certain aspects of the market are doing. Are the institutions putting on more of a position or less of a position? So CMT, I'm not really performing deep technical analysis on it, but I am looking at it, and I am looking at it through the eyes of what is the trend in the COT. So yeah, at the symposium in April, COT really didn't come up, but certainly when we talk about it, or Jim and I talk about it, or Mike and I can talk about it, it's always, you want to see it graphically, and you want to see what the trends are for the different components of the COT.
I know that you guys sometimes have Larry Williams on the show, and I would love for Larry Williams to be asked this question. I've actually asked him this question several times when I've met up with him, and I've been watching Larry Williams stuff for many years. And I've had the pleasure of meeting with him and talking with him a lot over the years. And he is someone who will say, you got to watch COT data for commodities, throw it out the window for the S&P.
Yes.
Right. And like I said, some people will totally disagree with that. My friend Jason Shapiro, Crowded Market Report, I follow his stuff. He's fantastic, but he has a strategy that goes along with the way that he does it. And he actually finds value with using it in the S&P and NASDAQ and Russell and all that. And for me as a trader, I don't really look at it for those markets. But when it comes to like oil, when it comes to natural gas, when it comes to the softs, when it comes to all these commodities, I think you're doing yourself a massive disservice by not looking at it. Because once again, people have to do something. And I think about it as a commodities. And when you get new people into futures markets, and you're coming from stocks, or you're coming from crypto, or wherever it is you're coming from, you have to realize this is a different animal. And it's a different animal once again, and I'm going to keep saying it because people have to do something. There is actually prices that are going to go and impact everybody in society. And so therefore, the data points or the things that you're doing to get your information is extremely important. One of the things that I look at for COT data regularly is, are you seeing build up in positions to the long side in a weak market? Are you seeing build up in positions to in a strong market? Are you seeing selling into a strong market, selling into a weak market? And then you can go and lay your technicals on that and look for squeezes. And I think that's one of the things that I like to do. I'm actually going to go to the charts before we go today and talk. I'm not going to show COT data, but I'm going to show just order flow and how sometimes it can help me with commodities. I want to talk about something else though, expiration dates. I already kind of really briefly talked about this. Expiration dates on futures contracts are so important. And I always say that this is really, truly what separates the pricing of the S&P futures, even though I know today we're talking about commodities. S&P futures expire, SPY doesn't. So at that expiration, that gives a true settlement to where we are on the end of the day, end of the month, end of the quarter. And to me, when you're talking about expirations for commodities, it's so important because where they go out, people always say it's not how you start the day, it's how you finish it. And when you look at commodities, where they go and expire is the most important price of it. And so there's a lot of price movement can happen going into the expiration. And a lot of times I'll look at gold, natural gas, go back to that oil move I talked about. When you get near expirations, if you've got a lot of people long that are potentially looking to take delivery and maybe they don't want to, right? Like, especially like when it comes to like the gold market, you'll see it a lot where you'll see a really long position going into expiration in gold. And a lot of people are like, I don't really want to take expiration of it. I'm just doing, I'm price speculating here. And you'll see a move that comes off. And that's where like those COT data, you could find those little nuances. It's very interesting because remember, they're physically delivered. And so that's why COT data and expirations are so important. Can
I interrupt real quick, Anthony?
Go ahead, of course.
This is one thing that I've always heard. You hear about the physical delivery of, maybe somebody is speculating and they're not, something happens where they actually have to take delivery. How often does that happen? Where you and I are speculating, let's say in corn, and then we don't roll over our position. We don't get out of our the contract that we're long with the expiration. It expires. Now we have to take delivery of corn. How often? It's almost like an urban myth from what I've heard. But have you known somebody, or is that an experience that you've seen where somebody had to take delivery and they didn't mean to?
Well, modern day, no. Modern day, I would say in the last decade, no, because the brokers are all on top of getting people out beforehand. And in order to actually take delivery, you have to have an agreement with the exchanges, right? So it's not like, oh, I'm long crude oil, you're going to have a bunch of barrels come to your house. Although there was a guy in the pit many years ago who was trading crude oil that we knew. I didn't know him personally, who was buying a bunch of crude oil and didn't realize it expired. And then I don't know exactly what happened and unfolded from there. But those days it was probably common for people to easily have that mistake. And I don't exactly know what happened. There wasn't a ton of I would say, stories about that. But in modern day, no, I don't know of anyone that it has happened with. But in the reality is like, but it goes back to it. If you wanted to do it, you can do it. It's funny. I actually was talking with a group of traders not too long ago at a meetup that I did. And they didn't realize that like the crude oil market or the gold market, like you actually can take delivery. And I was like, wow, that's pretty interesting that you didn't know that. Now I grew up in the futures business. And so for me, it's just something that we've always known. Like, it's because you're on the floor. And I actually remember when I started in the meets, I was a runner in the meets, and there was literally guys talking to farmers on the phone. And I was like, what? And when you actually see it and hear it, it resonates with you a lot more. But when you see the price of live cattle, you're like, oh, there's no way. If you bought live cattle and you take delivery, guess what? You own live cattle. And it is hard to comprehend, but that is why futures markets are so important. And it is also why I'm doing today's show, to make everybody understand that that is the driver behind it. And I would bet that there's a lot of traders out there going to find some unique approaches to be able to maybe find some edges trading these products if you look at what's happening. And like I said, these are markets you have to go beyond the charts for. I want to go to contango and backwardation real quick, because this is something that you'll see a ton of people, especially in like oil and natural gas, talk about this. First thing I will say about oil and natural gas, I am somebody who trades oil. I really don't trade much natural gas, but I will tell you this, majority of the most successful people I know in the energy space trade spreads. Almost all of them trade spreads or options. Very, very few that I know on the really successful level trade the front month of natural gas or the front month of crude oil. That's where traders like us, who are smaller in nature to these other guys and girls in this business, they're trading out, and they're trading spreads, and they're trading options. That's where the really big traders are. The front month is kind of like, oh, well, that's to them. It's not something that a lot of the traders will look at. And it's always interesting for me to realize this, because I've always been a front month S&P trader, NASDAQ trader, Russell trader, whatever. When you get into the oil market, I'm like, oh, the front month, that's where the action is. No. And so when you look at contango and backwardation, most of you probably know this, or maybe you don't, but contango is a market condition in which the price of a futures contract is higher than the spot. Backwardation is the opposite, it's lower. And so when you look at that in commodities, right, you're going to see people that are going to go out and trade way out. They're going to trade a lot further out, and they're speculating on what's happening now versus, how can they buy something that in the future eventually versus, actually, let me rephrase this. They're buying so much further out than just this next expiration. They're looking at what's happening on inventories and things and how it's going to impact, deliveries months and even years down the road. That's where these really big players are. And so when you see contango or backwardation, it makes you understand that, at least from my perspective, that the bigger players are pricing things out that way. And so that's why that's so important. And the spot price is only one little piece of what's really happening in these energy markets. And I don't really follow contango backwardation too much in the softs, which would be like the corn and wheat. But I do know in oil and natural gas are extremely important to the big players that I know. And, supply and demand, how it affects it, I think I've talked about that a lot today. Once again, I have this here in the chart deck. It's so important to understand this, because you don't want to be in a position that you are going to get turned out of, or you're too big in, and you get turned out of because of these events. It's a big reason why I never really hold any commodities. Even lately, I've been trading crude oil, and you don't know overnight. The news events can really have a strong impact on these markets. I know I'm stating the obvious here, but it's why it's one of these things you really, really have to know what you're doing when it comes to these markets. And that's why a lot of the bigger players have spreads on, because they have the spreads on because they can withstand some of these things that happen versus just being in and outright, where if you're in and outright in crude oil and there's one little thing that happens overnight, which I've been trying to be long lately, it could blip down, get you out, and next thing you know, it's right back up again. And that's a big reason why a lot of these bigger players trade the spreads markets. And also the relationship with the US dollar. You cannot trade commodities and not watch the dollar. And it's so important because everything is priced in dollars. And if you go and talk to my friends in Europe, or if I talk to my friends in Asia, their majority of, even when they're looking at markets, when it comes to commodities, it's priced in dollars, right? Because we're the largest currency out there. And so if the dollar is going down, then these other commodities potentially can go up, or vice versa. It's not always the case, but you have to keep an eye on it, because would you rather own something? If you're owning something in a commodity, you want to know how the dollar is going to be acting, because it's going to determine the pricing of your commodity. Once again, it's one of those things where it's beyond just you looking at a trend line in wheat, right? And the final thing is that's true supply and demand. We come back in here with you, Tom. I'm curious. I want to ask you a question about this, because I think when you look at the technicals, majority of us are very technical based, and we're technical based because that's all we have. When I look at the chart, to me, I look at what's happened, and I look at indicators to paint a picture of what's happening forward. But really, like I said, when you look at futures markets, the beginning of this was all commodities. And when you get into a CMT, I'm curious, what are some of the most popular tools that you would see technical people use to gauge price action in commodities?
So, that's a good point. I deal extensively with the CMT in terms of the materials and for the testing, right? So I'm on that testing committee. And so commodities is not a huge part of the CMT. However, when it is used as an example for technical analysis, a lot of it is momentum. A lot of them are momentum strategies or momentum indicators, and really kind of trend indicators as well. We don't really go into the fundamentals like you mentioned, the spreads, right? We don't talk too much about spreading in the commodities market because that's not the point of the CMT. It's really about using the tools to analyze any market. So it really is a basic technical look at data. And when commodities comes up, it's pretty much what is the momentum, what is the trend. We don't go into the different strategies around calendar spreads or different product spreads, cracks, crushes, the like. So that's kind of where I come by, but I don't see any different from what you're doing for commodities than you would do financially in terms of technicals.
So I'm going to wrap this up today with what I think are really the keys for people like us that are going to trade commodities. One is do your homework on the COT data. Obviously, Larry Williams and Jason Shapiro, two of the best that I know. They're the guys that I follow for this. I always stay in my lane. I know where I'm at. Go to COT data and learn more from guys like that. They're tremendous. Understand positioning. And then from there, you go to the charts, right? And I'm not going to say, actually, I know even for COT data, if you understand the positioning, it's too much of an edge, but it's something that you need to see because you want to see what's building within the market. And then what I'll do is I'll come over here and I'll look at, like, let's say I look at crude oil right now. What I like to see is when I'm looking at just this order flow cumulative delta, I actually did a show not too long ago on crude oil, and I talked about how I really like this. I don't use the auto-anchored VWAPs as much because I try to be less technical, more volume driven, more overbought or oversold, just as Tom said when he talked about momentum. And that's why I was interested to hear what he said. When you look at it from this perspective, what I like to see is, okay, what's happening in oil? And I always get a good glimpse of it. So you could see these green bars here. This is going to be net delta for the day. Are they buying or are they selling, right? What is the net delta in the day? Buyers versus sellers, buyers on the offer, sellers versus the bid. And what I look for is when the markets are making highs or lows, or not making highs or lows, you're near double tops or double bottoms, what's happening in the net delta. And you can see here, it's pretty interesting. You had a market that fell off back here. It was just several months ago, and in the crude oil market, and you see the net delta came up, which means that when price got cheap, delta spiked to the upside. So although we had a few down days, delta was net up, which means that as we were going down, a lot of people were stepping in and buying offers, right? Look back at that point right there, and that's a low, right? And then you see back in here, sellers tried to push when we were getting near these lows, but no new lows. You see build up, build up, build up. This is typically what bull markets look like, even though crude oil has been in a very sideways range. I said I'm bullish of it lately, and this is part of the reason. Then you see sell off. You see quick spikes lower, but no lower lows. So you see volume comes in, and the market gets hit pretty hard with net delta volume, but no lower lows, right? And so it's just weak hands. And you see them building, building, building again. You see sellers try to step in and sell on this recent rally. And guess what? Price takes it higher. And so when I look at things like that, that just gives me an overview of saying, look at, the people who have been long there are now selling into this rally. Potentially, you're just thinking about this and they can't take price lower, even though there's net more sellers than buyers. And that's very important, right? Let's take a look at wheat. I was pulling up wheat the other day, and I'm not trading wheat. I have a few people that have always told me, they're like, Anthony, don't trade wheat. It's just one of those markets I watch a lot because it impacts us as consumers. You look at wheat, big rallies higher off these big moves, there is sellers on every one of these rallies. It's pretty interesting, right? And I keep seeing it. I'm like, man, every time the market rallies, there's sellers, right? At some point, all of a sudden we make a higher high and these net sellers got to turn buyers. Who knows? I mean, it's one of those things. I'm not trading it, but this is why I like looking at volume. You could see, look at yesterday, big price move higher. I talked about some news in the Ukraine. People use that as a selling opportunity. Price is higher again today. Kind of interesting, right? Soybeans is another one. You know, I was watching this. I don't have a bunch of data on here because I think it's recently rolled. But when you look at it, just one of those things. It's making higher highs. You watch it, look at the delta. I don't have a ton of data on there. And also same for coffee. It's another market I look at because I like to drink a lot of coffee. I actually have traded coffee a few times in my career. It's not really my favorite market to trade. Once again, it's just one of those things. If you're trading in one of these markets, look at the order flow, look at the overbought or oversold. I like things like this. You could see coffee's seems like it's been oversold for some period of time. It's just not doing much there on the charts. But I just wanted to actually one final one I wanted to pull up was live cattle. Let's end on this one today because I know we got to go to Ask DYE. Look at this rally. And it's interesting, you know, I go back and look, it's overbought. This is something I want to say too. When you get into commodities, these things stay overbought or oversold a lot longer. And you want to see when something is overbought or oversold in a commodity, that when it comes out of being overbought or oversold, I actually like to see volume come in with that new direction. So if we're overbought and you're getting, you know, staying the RSI, stay that, I don't want to start to look to short this market until I say it's come out from overbought and then seller step in. That's when you want to come in with that volume. And so that's just a kind of quick glimpse of what I look at when I'm trading commodities.
Awesome. Thanks. You know, to that point with the RSI, you're right at that overbought level and it could turn around anytime. You also have a lot of divergence from that really oversold period in June. You've come off of that with the RSI, right? You were over 80. Now you're only at 70, but price is going up. It can't sustain is what the RSI is saying. But that cross below 70 to me would be a really interesting signal. So
this is why I think when you look at something like this, that COT data makes a big difference, because if everybody is loaded long and it starts to come out of it, and then all of a sudden you get into expirations, this is when you look for squeezes. I personally like squeezes in commodities more because I'm not really, you know, some trend followers will only trade like these types of trends. I like to look for the squeezes. That's why I like COT data, because if everybody's positioned long near the top and it comes out for being overbought, and then you start to see sellers step in, then you have expirations coming up and you have people that say, do I really want to take this delivery at these prices? Maybe I could buy it cheaper. And that's when you see squeezes. Those are my favorite types of looking trades when I look at commodities. And that's why I really just look at overbought, oversold, COT data, and cumulative delta.
Awesome. Thank you, Anthony, for that. Let's do Ask DYE real quick. If you have a question you want to ask Anthony, you can go to Twitter, ask a question, put the hashtag AskDYE, and also our handle at NinjaTrader. If you're located in the US and we use your question, we can send you something nice. We'll reach out to you through Twitter. But today's question, this week's question, is from John Moser at John Moser 66. What are the tax advantages of futures trading?
So it's 60-40. And that means that 60% is going to be at long-term capital gains, 40% is going to be at short-term capital gains, which is your Schedule C. And then you have to do a form 6781, which is Rule 1256. And I would obviously recommend going to an accountant and talk about this. But I've been doing this so long that I've remember those rules. And like I said, I'm not an accountant by any stretch. But you have the advantages of also carrybacks. You know, we have losses in futures. I remember I had a big loss in 2009, and I had to carry some of those losses back. And then you get some money back from the government as you pay your taxes. And so there's a lot of benefits versus stocks. And I'm actually not super familiar with the total how that works for stocks. If you're a full-time stock trader, I just know from being a full-time futures trader that you get the carrybacks, you get the 60-40, and you get those benefits. And so that's just really the broad strokes on it. I actually did. You can actually find some videos on my website in my membership area. It's free, where I spoke with people specifically about this. This is not my specialty, but I do understand it. But that's a great question because it's important.
Well, thank you for that, Anthony. And I know we have a little bit of business before we wrap it up.
Yeah, I just want to remind everybody, we talked about commodities, and, natural gas is a market that the Henry Hub natural gas has got futures and options at CME Group. And I know a lot of people, it's funny, Tom, you go along these years, people will say, well, how do I trade natural gas? Well, natural gas is a commodity that's traded at CME Group. You can learn more about it by going to cmegroup.com. And, Henry Hub is that area it's like it's the hub when it comes to natural gas. Like, once again, I am not the natural gas expert here, but I will tell you that if you want to trade natural gas, the price action, the futures market is at CME Group.
Awesome. Thanks, Anthony. Great to be back with you. Missed you for the last couple of weeks, but right back in stride. Appreciate all that you do for your viewers and our viewers.
Oh, thank you so much, Tom. And like I said, today, I'm glad that I was able to step in and talk about commodities. And I always say, look, I stay in my lane. That's why I trade the markets that I do. And I look at the tools that I use, and I talk about all of that here. But I just wanted to open up the world, everybody, to commodities and say and understand, first of all, where futures markets really came from, how that all kind of began, why they are different, and why you really need to go beyond the charts if you're looking at commodities. And hopefully today I helped you guys if you had any interest in trading some of these commodities.
Great. Thanks. Again, thanks so much, Anthony. Want to thank everybody for coming, and we will finish the day. I will finish the day with bars closing at 3:15. Hope to see you here next week, same time, Anthony, myself. In the meantime, have a great trading day.
See ya.